China just made a $2.9 billion oil deal without using a single US dollar. No SWIFT, no Wall Street, no clearance in New York. Just pure digital yuan, executed quietly, but with earth-shattering consequences. This isn't just a currency shift. It's a direct challenge to America's financial dominance. And while Washington was busy playing tariff chess, Beijing rewrote the rules of the entire board. On April 5, 2025, China's central bank confirmed it had completed a major cross-border energy transaction using the digital yuan. That wasn't just symbolic. It was functional proof that China can run trillion-dollar trade pipelines outside the dollar system, a system the U.S. has spent decades building and weaponizing. But here's the kicker. That $2.9 billion deal wasn't with a Chinese company. It was with a Middle Eastern energy supplier, and the U.S. had no seat at the table. This is no longer a trade war. It's an economic divorce, a quiet decoupling backed by hard moves. 125% tariffs on American exports, mass liquidation of U.S. treasuries, and the slow abandonment of U.S. tech, agriculture, and even semiconductors. Trump's tariff retaliation may have sparked it, but what China's doing now is something far more dangerous. It's permanent. If you've ever thought the dollar was untouchable, buckle up. Because today, we're counting down the 5 biggest signs that China just made U.S. exports useless and is cutting the dollar out of the global game entirely. You won't believe what's at number 1. And if you're watching this, don't just scroll, hit subscribe like you're telling a friend to stop ignoring a fire alarm. Let's break it down piece by brutal piece. Countdown begins now. Number 5. The 125% tariff strike, precision warfare disguised as trade. On April 10th, 2025, China didn't just retaliate, it launched what Bloomberg analysts are calling a precision economic strike. A sweeping 125% tariff was slammed on U.S. exports, targeting American cars, semiconductors, and agricultural machinery. But this wasn't about revenge. It was about leverage, because these aren't just random exports. They're billion-dollar industries directly tied to U.S. electoral politics and core Trump constituencies. Let's get specific. The Commerce Department confirmed these sectors brought in over $36.4 billion in export revenue to the U.S. in the previous year alone. And within 48 hours of China's move, the market reaction was devastating. Deere & Company, a Midwest agricultural equipment giant, lost $2.1 billion in market value. Meanwhile, Tesla suspended shipments to China entirely. U.S. soybean futures dropped 4.3%, pricing in fears of broader retaliation that hasn't even happened yet. But here's the strategic twist. China waited exactly 72 hours after Trump's administration dropped $88 billion in new tariffs on Chinese electric vehicles and rare earth minerals. The timing wasn't coincidental. It was surgical. Beijing's message wasn't just economic, it was political. According to Wang Yong, senior advisor at Peking University, this isn't defensive anymore. It's calculated deterrence. We're targeting pressure points. And one of those pressure points is the Rust Belt. Michigan, Iowa, Ohio, states that helped Trump win in 2016 and 2020, are now watching their key industries get hammered by ripple effects. The strategy? Undermine Trump's domestic support base without firing a single geopolitical shot. But what makes this more than a typical tit-for-tat tariff war is the underlying decoupling. While Washington thought China was just reacting, Beijing was actually pivoting. Instead of trying to win a short-term trade clash, they're systematically removing U.S. companies from their economic blueprint. This isn't about tariffs anymore, it's about erasure. Case in point, Chinese firms like BYD didn't wait for WTO clearance or public outrage. They simply cut U.S. suppliers. In one instance, BYD terminated a $500 million sensor deal with an American tech firm. No announcement, no negotiation, just deleted from a ledger. Why? Because under China's new phrasing from Ministry of Commerce, certain U.S. goods were deemed no longer commercially viable. It's not political rejection. It's disguised abandonment. and it gives China full legal cover to drop American partners overnight. This tactic shields Beijing from WTO retaliation while accelerating the purge of U.S. players from Chinese markets. Think of it as death by regulation. According to trade law analyst Henry Gao, this terminology is a regulatory green light for disengagement, masked as economic rationality. And the impact isn't isolated. U.S. companies are now trapped in a fog of uncertainty. Do they invest in China? Scale back? Hedge with new suppliers? The message from Beijing is clear. If you're dollar-tied, you're expendable. But the bigger story is that China's not doing this alone. Behind the scenes, major U.S. trading partners are starting to hedge their bets too, questioning whether U.S. trade policy is still predictable or even rational. Countries like Germany, Brazil, and Saudi Arabia are signing deals that sidestep Washington entirely, and we'll get to that soon. The real twist here? Trump may have fired the first tariff shot, but Beijing turned it into a systemic playbook, one that slowly suffocates U.S. economic influence under the radar. Because while Wall Street panics over headlines, China is redrawing trade routes, financial flows, and supply chains at the root level. And this 125% tariff wasn't the climax. It was just the overture. But if that was just step one, what happens when China pulls the plug on America's financial oxygen supply? Stick around. Number 4 is where the decoupling goes nuclear. Number 4. The silent execution. China slashes U.S. dollar holdings and kills the Greenback script. While the West was scrambling over tariffs, China was dismantling something far more critical, the financial backbone of American power. In Q1 2025, Beijing quietly slashed its U.S. Treasury holdings to just $668.6 billion, the lowest in over 15 years. That's not trimming the fat. That's slicing into the core of Washington's global leverage. The move barely made headlines, but its implications are seismic. U.S. Treasuries aren't just investment tools. They're the oxygen fueling America's ability to borrow, wage war, fund stimulus, and maintain global dominance. When China pulls out, it's not just shifting portfolios. It's sending a warning, we don't need your money. And soon, no one else will either. But this wasn't a one-off liquidation. It was part of a coordinated financial firewall. At the same time, China Construction Bank and ICBC, two of the largest state banks, halted all new dollar-denominated loans for public infrastructure projects. These weren't fringe experiments. These were multi-billion-dollar financing arteries that once flowed through the dollar system. And now, they're rerouted to the digital yuan, the euro, and other non-USD frameworks. Reuters confirmed that this policy wasn't just economic, it was geopolitical. China is building what it calls an internal insulation strategy. In plain terms, that means removing any mechanism through which the U.S. can sanction, seize, or strangle Chinese trade. And that insulation is working. In April 2025, Goldman Sachs Asia analyst Maggie Wei issued a stark warning. Beijing is engineering a soft retreat from dollar-linked liabilities to preempt future financial sanctions. Translation? They're not waiting for the next Trump tariff. They're preemptively cutting ties so America can't use its financial weapons when it matters most. This goes beyond economics. It's strategic divergence. While Washington plays checkers with tariffs and political points, Beijing's playing chess with monetary sovereignty. The twist? China isn't going to war with the dollar. It's simply walking away from it. And they're not walking alone. On April 5th, China confirmed it had completed a $2.9 billion oil transaction with a Middle Eastern supplier, entirely in digital yuan. No SWIFT, no New York clearing, no dollar. This wasn't a test. It was execution. And it proved something terrifying for U.S. policymakers. The dollar is no longer mandatory. Imagine if this model spreads. If China links these digital yuan systems with BRICS Pay, SIPs, or oil trading hubs in Latin America and Africa, the dollar won't just be bypassed, it'll be replaced. It gets worse. France is lobbying for a BRICS EU observer platform, Brazil is pushing to merge BRICS Pay with Latin payment systems, and Saudi Arabia is already running crude deals in yuan. Even Germany's BASF, a longtime U.S. ally, just signed a €7.2 billion expansion deal in China, ignoring American pressure. Trump's administration has been vocal about bringing supply chains home and reasserting dollar dominance. But the world's not listening. They're building alternatives, hedging their risks, and preparing for a future where U.S. financial threats hold less weight. Still think the dollar is untouchable? Think again. Even U.S. firms are feeling it. Goldman Sachs recently slashed its Q2 GDP forecast from 2.3% to 1.5%, citing export collapses and global payment system fragmentation. Deere, Archer Daniels Midland, and Caterpillar are bracing for further devaluation of China-bound assets. And Wall Street is no longer reacting to policy, it's anticipating collapse. The real kicker? The IMF's global outlook now projects China-led economic blocs will account for 33.6% of global GDP by purchasing power parity in 2025, surpassing the G7's 29.9%. The financial axis has already tilted. So, while Trump continues tariff tit-for-tats, China is severing lifelines. Not with noise, but with cold, calculated steps. And the moment that lifeline is gone, what's left? That's what we'll uncover in number 3, where China flips trade law itself into a weapon. Number 3, the legal ambush, how China weaponized WTO language to cut U.S. companies overnight. While most of Washington was still deciphering China's tariffs, Beijing was already executing something far more strategic and far more dangerous. On April 11, 2025, China's Ministry of Commerce issued a bland-sounding announcement that certain U.S. imports were now no longer commercially viable. No threats, no fireworks, just a line of cold bureaucratic language. But beneath that phrase lies a trapdoor that just collapsed hundreds of U.S. contracts. Here's why it matters. Under World Trade Organization (WTO) regulations, countries can't arbitrarily discriminate against imports for political reasons. But if something becomes economically inefficient, a country can legally end those contracts without retaliation. And that's exactly what China did. This wasn't a press release. It was a legal firewall. Instead of labeling U.S. goods as politically unfit, triggering WTO disputes, Beijing framed them as financially unjustifiable. The result? Full legal cover to purge U.S. companies from Chinese supply chains without penalty. Within 72 hours, BYD dropped a $500 million sensor supply deal with a major U.S. manufacturer, no warning, no public statement. Just gone. Dozens of smaller procurement contracts were axed silently. According to trade law expert Henry Gao, this single move transforms disengagement into market logic. Here's how the trick works. When the ministry says a product is no longer commercially viable, it sends a signal to every state-owned enterprise, tech firm, automaker, and agricultural buyer in China. The message? Cut the Americans. Now, the result? A wave of preemptive cancellations. Companies didn't even wait for direct orders. They're just following the regulatory breadcrumb trail, protecting themselves from future compliance risks while helping Beijing accelerate decoupling without a diplomatic scene. And there's a second twist. China is leveraging this move to build domestic alternatives fast. Instead of replacing U.S. suppliers with Japanese or European ones, they're pushing local Chinese firms into the gap. That's not just smart economics. That's strategic self-reliance. According to China's National Development and Reform Commission, more than $18.5 billion has been fast-tracked into import substitution programs since January 2025. And it's not just semiconductors or machinery. This covers U.S. soybeans, dairy, and agricultural tech too. The American Farm Bureau estimates that $8.6 billion in U.S. agricultural exports are now at direct risk, with forward contracts in Iowa, Nebraska, and Illinois falling by up to 37% compared to spring 2024. The kicker? It's all happening under the radar. American firms are being erased from ledgers not by loud sanctions, but by algorithmic decisions, regulatory language, and internal memos. It's death by 1,000 edits, and it's nearly impossible to challenge. And Beijing knows this. They're using the language of the market to execute geopolitical retaliation. It's brilliant, it's brutal, and it's leaving the U.S. with no legal footing to respond. Even U.S. allies are taking notes. Behind closed doors, trade officials in Germany, France, and Brazil are watching closely. If this model proves effective, regulatory decoupling could spread. Instead of confronting Washington head-on, countries may just relabel U.S. goods as inefficient, overpriced, or environmentally non-compliant, then walk away with WTO immunity. This isn't just China versus Trump anymore. It's a template for global disengagement. And what's Trump's response? Public threats, rallies, more tariffs. But while he's firing from the stage, Beijing is rewriting the script backstage. The damage is already being priced in. U.S. multinationals are scrambling to reassess exposure. Legal departments are tearing through contracts looking for loopholes. But it may be too late, because once a nation shifts from diplomacy to regulatory warfare, the target has already lost ground. Here's the bottom line. The U.S. isn't losing this battle in trade courts or stock markets. It's losing it in footnotes, procurement guidelines, and internal memos written in quiet offices in Beijing. And if that doesn't shake confidence in the U.S. export economy, number 2 will. Because now America's own allies are helping China rewrite the rules, and they're doing it in ways the White House can't block. Number 2, America's allies flip how Germany, Saudi Arabia, and France quietly sided with China. While the U.S. was fixated on China's tariffs and trade retaliation, a more dangerous shift was happening in plain sight. Some of America's closest allies, nations that once followed Washington's lead in trade and diplomacy, have begun hedging their bets. But they're not doing it loudly. They're doing it with quiet billion-dollar deals, offshore digital currency clearings, and soft defiance of the U.S.-led system. Let's start with Germany, the economic engine of Europe and historically one of America's most reliable trade partners. In March 2025, BASF, Germany's largest chemical conglomerate, signed a staggering €7.2 billion expansion deal in Guangdong, China. Not in defiance of U.S. policy, in spite of it. Why does that matter? Because Washington has spent the last 2 years pressuring European firms to de-risk from China to pull supply chains, cut dependency, and shift production. Yet, Germany is doubling down. According to Handelsblatt, BASF executives ignored U.S. diplomatic pushback, citing market realities. Translation: American pressure no longer carries the weight it used to, and Germany's not alone. In April 2025, Saudi Arabia completed a landmark oil settlement with China's Sinopec, worth $2.9 billion, cleared entirely in digital yuan. No petrodollars, no U.S. banks. This wasn't just a deal, it was a signal. For the first time, Saudi Arabia, the very country that anchored the petrodollar system in 1974, is embracing an alternative path. And they didn't ask for Washington's permission. According to sources from the Financial Times, the transaction involved no U.S. financial infrastructure whatsoever. It was conducted through China's cross-border payment system, settled digitally, and processed outside SWIFT. The implications are massive. If Saudi Arabia normalizes energy trades in non-dollar currencies, it could cripple the dollar's role in global oil markets. That role isn't just symbolic, it's foundational. It props up global demand for the U.S. dollar, allowing Washington to borrow cheaply and sanction freely. And now, that foundation is showing cracks. But perhaps the most politically alarming shift comes from France. While Emmanuel Macron hasn't declared any policy rupture, French diplomats are actively lobbying for a new BRICS, EU observer platform, according to leaked memos from Brussels. That's not just geopolitical curiosity, it's a strategic hedge. Brazil, meanwhile, is leading efforts to make BRICS Pay interoperable with Latin America's regional payment system. The goal? A new trade architecture where countries can bypass the dollar entirely, and not just with China. These aren't isolated acts of rebellion. They're quiet exits from the dollar-based world order. And here's the plot twist. Many of these allies aren't anti-American. They're just post-American. They no longer believe that Washington can or will stabilize global trade. And with Trump's volatile tariff strategy, bipartisan gridlock, and heavy-handed diplomacy, who can blame them? In fact, Citibank strategist David Lubin put it bluntly, a multipolar trading order is emerging and Washington is no longer the default center. That's not just opinion. The data backs it up. Cross-border investment flows between the U.S. and China fell 58% year-over-year, while China's exports to ASEAN jumped 7.4% in Q1 alone. These regional partnerships are quietly replacing U.S. dominance with localized trust networks. Even Wall Street is starting to reflect this shift. Goldman Sachs, BlackRock, and HSBC have all expanded yuan-based trading desks, not because they believe in Beijing's politics, but because the markets are moving. So, while Trump threatens tariffs and tweets, America's global trade position is being rewritten behind closed doors, not by enemies but by old friends choosing new futures. And that brings us to number one, the most critical and terrifying signal yet. China just proved it can run global trade without America, and Wall Street is already pricing in the death of the dollar system. Number one, the $2.9 billion digital bombshell. China proves it can kill the dollar without firing a shot. On April 5, 2025, China executed what may be the most consequential financial transaction of the decade, and almost nobody in Washington saw it coming. The People's Bank of China confirmed it had completed a $2.9 billion cross-border oil deal using only the digital yuan, bypassing every traditional U.S. system. No dollars, no SWIFT, no Wall Street. Just pure digital currency cleared between Sinopec and a Middle Eastern energy supplier whose identity remains confidential. But make no mistake, this was not a one-off stunt. It was the proof of concept the world had been waiting for, that China no longer needs the dollar to operate in global energy markets. And if that sentence doesn't terrify U.S. strategists, it should. This is not about convenience. It's about sovereignty, financial sovereignty, trade sovereignty, and eventually geopolitical sovereignty. Here's why this changes everything. For over 50 years, the petrodollar system has been the beating heart of U.S. global dominance. Oil has always been priced, traded, and settled in U.S. dollars. That created automatic demand for dollars across every continent, allowing the U.S. to issue debt cheaply, enforce sanctions broadly, and control global capital flows. Now, China has just punched a hole in that system, not by lobbying OPEC, not by protesting the WTO, but by simply building an alternative financial highway and driving a $2.9 billion truck full of oil across it. According to Financial Times insiders, this wasn't even the first such deal, just the first one confirmed on record. Analysts now believe China is scaling up these digital yuan trades, aiming to integrate them into platforms like BRICS-Pay, CIPS, and future digital energy bourses in Latin America, Africa, and Southeast Asia. This isn't just an attack on the dollar. It's a replacement strategy, and it's working. The consequences are already rippling across global finance. Wall Street has started pricing in the threat. On the same day as the digital yuan confirmation, the Dow Jones plunged 1,000 points, erasing $520 billion. Goldman Sachs slashed its Q2 U.S. GDP forecast from 2.3% to 1.5%, citing rising risks of dollar displacement. U.S. agribusiness giants like Archer Daniels, Midland, and Deere issued warnings that $3.2 billion in China-bound inventory could now be disrupted or repriced. But it's not just numbers, it's psychology. For decades, the U.S. dollar's power wasn't just in its utility, it was in its inevitability. The belief that no matter who you traded with at the end of the day, you needed dollars. China just shattered that myth. Even the United Nations is starting to reflect the shift. The latest SWIFT data shows the Chinese yuan now accounts for 6.3% of global cross-border payments, up from just 2.2% in 2020. That may still be small, but in percentage terms, it's a 187% increase in 5 years. And it's accelerating. And here's the geopolitical twist. China isn't using these systems to gain control. It's using them to disengage, to insulate itself from U.S. sanctions, U.S. regulations, and U.S. political cycles, especially Trump-era volatility. According to former U.S. Trade Representative Robert Lighthizer, we underestimated their ability to work around us. Sanctions and tariffs may now be producing the opposite of their intended effect. In fact, the more Washington pressures, the faster China builds escape hatches. The digital yuan, central bank clearinghouses, and cross-border payment networks are all responses to American leverage, not challenges to it. This is no longer theory. It's execution. It's happening. And it's happening fast. So, where does that leave the United States? With an export sector on the ropes, a 33.6% share of global GDP, now tied to the China-led bloc, and an international trading system that increasingly views U.S. oversight as optional, not required. And if that wasn't enough, Huawei just launched a 7-nanometer chip built using Chinese lithography tools and Dutch stockpiles, sidestepping U.S. tech bans entirely. The point? Even tech dominance is eroding. This is what happens when financial control meets strategic discipline. While Trump escalates tariffs, China quietly exits the game board and builds its own. The real question isn't how the U.S. fights back. It's whether it even has a place in the next system at all. And if the global trade system is being rebuilt in China's image, who gets to sit at the table? And who's left begging for an invite? Final thoughts. Let's be clear, this wasn't a trade dispute. It was a strategic unraveling, thread by thread, executed with military-grade precision. From the 125% tariff strike to the $2.9 billion oil deal in digital yuan, China didn't just push back. It rewrote the entire playbook. And America? It's still clinging to rules that no longer apply. The data doesn't lie. U.S. exports are collapsing in critical sectors, Treasury holdings are evaporating, and the dollar's supremacy is being bypassed in real time. Meanwhile, allies like Germany, France, and Saudi Arabia aren't resisting, they're adapting. Not because they've turned on the U.S., but because they no longer believe Washington can hold the center. Trump's tariffs may have sparked this fire, but Beijing brought the accelerant. Every move was planned. Silent withdrawals, soft currency pivots, legal disengagement masked as market logic. And the biggest twist? China didn't need to beat the U.S. in a war. It simply needed to make the dollar optional. Now, the U.S. faces a landscape where its traditional tools, tariffs, sanctions, dollar dominance, are losing bite. And Wall Street knows it. The question is whether Washington does. Because if China continues this pace of decoupling, the U.S. won't just lose trade. It could lose the very architecture of global influence. So here's what we're left with. Is the world entering a post-dollar era? And is America prepared for it? Let us know your thoughts in the comments. What should Washington's next move be? And if you made it this far, don't scroll past. Hit that subscribe button like you're pulling the emergency brake because we're just getting started. We break down the strategies behind the headlines so you're never caught off guard. Thanks for watching. Stay sharp.